Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoy this video, drop it a like and hit subscribe. But for now, let's get into it. So in today's video, we're going to talk about the multi-trillion-dollar question I'm going to have a go at. Is the stock market overvalued? I'm going to give you my opinion on what I think the market value is looking like at the moment, and a few reasons why I think that maybe it is slightly overvalued at the moment, and what you should be kind of doing in this sort of situation. So the first indicator I'm going to look at is something called the Wilshire 5000 to GDP indicator. Bit of a long name. This is also known as the Buffett indicator in a lot of investing sort of circles, and essentially this is a ratio. So it's looking at the Wilshire 5000, which is 5,000 publicly traded US companies, the vast majority of companies in the States. It's looking at their total market cap, and it's dividing it by the GDP of the US. So essentially Warren Buffett thinks that when this ratio is about 1 to 1 or less, so if the Wilshire 5000 value is actually less than GDP, he thinks that's a great time to be buying stocks. When it's about 1 to 1 ratio, it's still a pretty good time to be buying stocks, but we're getting towards probably a fair value. And when the Wilshire 5000 is actually at a much higher value than GDP, that's when we should start to get a little bit nervous and a little bit wary of the overall values of companies that are being traded. So the first thing we've got to look at is where is this Wilshire 5000 to GDP ratio sitting now, and where is it kind of set in the first I'm going to take you back to the dot-com bubble of the late 90s, early 2000s. We had a massive overvaluation in the stock market. There was a huge crash, especially in a lot of technology companies. So what was the GDP to the Wilshire 5000 to GDP ratio looking like then? So around the year 2000, the Wilshire 5000 to GDP ratio peaked out at about 120%. So the value of the Wilshire 5000 was about 20% more than the total GDP of the United States at that time. From there, plummeted well below 100% before the recovery in sort of 2002, up to the next crash in 2007, which I'm about to get to. So in 2007/2008, the global financial crisis, where did that Wilshire GDP ratio get back up to? And the answer to that is it got up to about 110%. So looking at this metric, not quite as overvalued as it did get to in the 2000s, or the early 2000s, but it peaked out over 110%, crashed back down to, again, well below 100%, and now we've come back into this most recent market cycle. So in terms of where we're sitting at today, if we look at what this ratio is sitting at in 2019, if you've got any guesses on where you think this is sitting, if you're not familiar with this, go and drop a comment down below now and let me know what you think. So in 2019, as of sort of recording this video, the Wilshire 5000 to GDP index is right around 180%. You heard that right, 180%. So this particular metric is screaming overvalued to us at the moment. There's a lot of factors that play into this. There's not as many publicly traded companies as there once were. There's a lot of private companies, again, producing GDP, which does have an influence on this ratio, but 180% is not something that we should be ignoring. That is, about as many red flags as we can see, and as high as this ratio has ever been in the past. So that's my first metric. Let's get on to the second one. Number 2 is the Shiller PE ratio. So the Shiller PE ratio was developed by a guy called Robert Shiller, who I believe is from Yale over in the States. And essentially the Shiller PE is a giant PE ratio. So if you're not familiar with the PE ratio, typically it's used for individual companies, and it's essentially a multiple of earnings that company is typically traded for. So shares are bought back and forth for around a multiple of earnings. So if we look at one particular company, the there's a wide range of PE ratios for individual companies, but typically over about the last century, the PE ratio for individual companies has averaged about 15, as has the Shiller PE ratio. The Shiller PE ratio has actually been slightly higher, which I'll explain the reason for that in a sec, but it's been about 16, so not a huge amount higher for the Shiller PE ratio. Essentially, the Shiller PE ratio is a PE ratio of the entire US stock market. So it's looking at the entire earnings of the US market versus the entire market cap of the market. And essentially, it's very similar concept to the Wilshire 5000 to GDP ratio, although rather than using GDP, which accounts for sort of all the earnings of the country, we're looking for the earnings of just the publicly traded companies to be included in the Shiller PE. The other thing that the Shiller PE does, and the reason why it typically spits out a slightly higher number than a simple PE ratio, is the Shiller PE looks at the basically 10 years worth of earnings and their 10 years of inflation adjusted earnings. So rather than looking at what a company's earned in the last 12 months, which is typically what's used for a PE ratio, it's looking back in the previous 10 years. So since the US market has obviously had a long history of growth over, centuries now. The multiple that's paid is on slightly lower earnings. If you look at a 10-year average earnings, they're typically slightly lower than just the previous year's earnings because those earnings are growing over time. Hopefully that makes sense. So that's what the Shiller PE ratio is looking at. 10 years of inflation adjusted earnings relative to the price that companies are currently being traded at. So just like the Wilshire 5000, let's have a look at what this ratio has done in the past. So first, again, let's look at the dot-com bubble in 2000. So in 2000, this ratio, I'm just having a little bit of a look at my piece of paper, this ratio peaked out at about 45. So this was through the roof. When we look at, the average of the last century being 15 or 16, and in 2000 it got to 45, this ratio was again screaming overvalued. Went down through the floor when the stock market crash did happen in the early 2000s and came down to more of a reasonable valuation like 15 or 16. So that was what happened in 2000. In 2008, this ratio got up to 27. So again, we're well above the 15 or 16 in 2008. 2007, 2008, when the global financial crisis happened, we were again getting very overvalued up into the 27s, almost double what a typical Shiller PE ratio looks like. So that was 2008. If we look at what the Shiller PE ratio is doing today, and again, if you want to have a guess at this before I tell you, drop a comment below, and I'm actually going to be linking up the websites that I'm getting this data from in the description, so feel free to click on those links and have a look for yourself. But the Shiller PE ratio as of 2019 is about 29.7. 29.7, and this was actually higher back in 2018. So we've obviously had a recent pullback in sort of late 2018. This ratio was actually north of 30. I believe it got to around 32 at the end of 2018, and now we're down to about 29.7. So it has pulled back a little bit, but again, we're nearing double what a typical, historical average is for a Shiller PE. So that's ratio number 2. Let's get into the third reason why I think that the US markets are overvalued at the moment. The third reason why I think the market's overvalued is when we actually look at individual companies, we start to see some pretty crazy numbers. So what I would typically advise people to do is pick individual companies anyway. That is my strategy. Even if the market is overvalued, there's typically something that's getting beaten down for a reason that just doesn't make a whole lot of sense, and we can typically find companies at a good value. What I thought I would do though is jump into some individual well-known companies and do a quick and dirty valuation on them, I guess. So I do have a video on stock valuations already on the channel, so if you're wondering how I'm getting to some of these numbers, definitely go and check that video out. It came out probably 3 or 4 weeks ago, so go have a look at that one. But I'm going to look at 3 companies. So I've got Apple, Microsoft, and Coca-Cola are the 3 examples I'm going to look at. And to do this valuation, I need basically three bits of info. So I need the earnings per share of the company for the previous 4 quarters. I need to forecast a growth rate for the company for the next 10 years. In this case, I'm going to be looking out. I need a future PE ratio, which in this case I'm being pretty lenient here. I'm using today's PE ratio. Typically with some of these companies which are still relatively fast growing, that PE will actually come down over time, but I'm going to be nice and leave a higher PE ratio. And that's going to allow me to work towards a value. So again, if you're wondering how I'm getting to some of these numbers, go and check them out. But these are the valuations that I've come up with for these 3 companies. So I've assumed Apple in the first instance is going to grow at 10% a year. I'm giving them a PE of 14, and then I'm working back at an appropriate sort of discount rate. So I'm using a discounted cash flow method, if you are familiar with that. And I'm landing on a value for Apple of $108. That's what I think a fair value for Apple is today. Currently it's trading at $166. So that's about 50% above what I think it's worth. And if you're a value investor, you're not buying at what I think the value's worth either. Typically you want to buy at a large margin of safety. So for me to actually want to go out and purchase shares in Apple, I'm going to be looking for this value to be more like $50 or $60, to be perfectly honest. So in terms of going out and buying shares in that company, it's just too far out for me at the moment. Apple would have to do some ridiculous growth numbers to justify buying those shares for me to be able to get a good return. And at the scale Apple's got now, I just don't think that's doable. So that's Apple. Microsoft, pretty similar sort of situation. So again, we've got EPS, growth rate, and a PE. I'm landing on a value of $84 versus the current share price of $103. So again, that's a pretty big difference. So that's roughly about a 25% overvaluation of my value versus what the company's currently being traded at in the market. So when we look at individual companies, we are seeing some pretty steep valuations as well. I mean, when you're looking at what companies were trading for in 2007, 2008, you could pretty much throw a dart at anything, at any company you wanted, and you could find it for 30, 40, 50, 60, 70% discount to their estimated value. Whereas at the moment, pretty much every decent company you look at is either trading at or above intrinsic value. So that's Microsoft. The last example I have is Coca-Cola. And I'm going to be honest here, I haven't done a lot of research into Coca-Cola, so this is a very rough one, but I've picked out their earnings from about 3 years ago because they had a bit of an outlier earnings these last 12 months, which were very low, not all that representative, but I've chosen $1.60. I've picked out an analyst growth rate of 7.5% just from what I found online. And again, I'm using a pretty high PE multiple for Coca-Cola. So currently they're trading at a much higher PE than this again, but again, that was due to sort of their outlier earnings. So I'm using the higher end of what Coca-Cola's historically traded at, which is 20, and that lands me on a value of around 16. So 16 versus the current price of 49. That's not even close to a buy for me. That's a massive overvaluation. So don't take my word for these numbers if you are looking to make investments. I have got a video on how to run them, but definitely do research and use your own numbers. But those are kind of my thoughts on what these individual companies are actually doing at the moment as well. And it's not pretty if you're a value investor and looking to generate some high rates of return. So as far as what I think you should be doing in this particular market, essentially, I think you should be sitting on the back burner a little bit. Again, I'm not a financial advisor or anything, but this is what I'm doing and this is my opinion, and I've given you some reasons why. I personally think you should be holding a lot of cash right now. I think you should be camped out. There's a lot of very, very well-known, very successful investors doing this at the moment. Warren Buffett's sitting with about $100 billion or so in cash. A massive percentage of his capital is just in cash and in kind of short-term bonds and things at the moment. He's basically camping out for one of these really, really big companies to come on sale so that he can purchase shares in it. I mean, he's continued to buy Apple, for example, over the last couple of years, but he's really slowed that down in the last 6 months, where their price crept up to the $200 level. I'm going to be pretty interested to see what comes out in his next 13F filing to, you know, see whether he has actually started to buy again since those prices have come down slightly. But for me personally, I'm continuing to take the time to do a lot of research into companies I'm interested in, really familiarize myself with the businesses and get some prices in mind so that when a correction does happen, if it does happen, fingers crossed it does for me, I'm not overly invested at the moment. I am holding a lot of cash, sort of, 50% cash I'm talking here, so a high proportion of cash versus equities. I'm getting those buy prices in mind. I'm really understanding a good range of businesses and building a watch list so that when these valuations do come down, I'm ready to purchase up large. I'm not running around like a headless chook trying to do research at the last minute and buy things willy-nilly. I'm taking the time to do that now and taking a lot of time to learn kind of the best approach for what happens when a correction comes. So, you know, as Buffett says, when it rains gold, you don't want to be out there with a thimble, you want to be out with a wash tub. And by a wash tub, he means you want to have a lot of cash to pick up and collect that gold when it is raining down. Buy those companies really cheap. So that's my strategy. I hope you enjoyed the video. It did take a bit of time to pull out all these numbers and run through these things with you. So I'd appreciate it if you dropped it a like. I also noticed we just hit 50 subscribers on the channel. I'm pretty new here, so I'm quite stoked with that. So love to see you next time. If you're not already subscribed, please do. Drop me a comment below. Love to hear thoughts on this kind of conversation as well. But for now, that's all from me. Cheers.